Hello, everyone. Good afternoon. First and foremost, many thanks for my panelists, Suhaimi, Sata, and Min, to join us together today to talk about impact investments. Also, thanks to my colleagues for setting this up. I think they have been doing a fantastic job so far. We launched our festival last week, and things are going on pretty well. Needless to say, we are doing this virtually, where we wanted to do this physically, and what matters most is the network that we get, the friends that we make when we do physically. But nevertheless, we are where we are now, and it is what it is now. So let's start with topic today on impact investments. I just want to start by saying that there's a lot of buzz on this term impact investment. A few definitions, a few naysayers, a few supporters, and so forth. But I like to simply put, impact investment at times, or mostly these days, they will say that it's another way of doing good. But can we then turn it the other way around and say that it's another way of making an investment? So it is two sides of a coin. And I think this afternoon, we can get different views from different panelists. I mean, these panelists, they have their day job, but they have their full-time job. But for sure, they have dabbled on this domain of impact investment. So with that notion of another way of doing good or another way of making an investment, I'll give you all 5 minutes each to give a bit about what you guys are doing in the areas of impact investment. Maybe you can share a bit about your day job if you have one, but nevertheless, it gives a full picture when you give your views. I think it's not a new thing, impact investment in this part of the world. It is still developing, but it's good to hear your thoughts. So 5 minutes each on, and we also have a social entrepreneur here, Min, that has been invested by both impact investors and institutional investors. So she will give an insight, whether is she a victim or a benefactor of impact investment. So, but that will be very refreshing to hear her views. So I'll start with Suhaimi. Tell me a bit about your views on impact investment, and where do you see it's going in the next few years, and how strong is the momentum of impact investment and social enterprises in this part of the world?
Okay, thank you, Elfie. Firstly, I'll start by saying it feels a bit odd not to have to unmute myself before speaking. But it's good. It's good to be here. Thank you to Reyes and Elfie for inviting me. My day job, as Elfie alluded to, I have a day job of running a quantitative hedge fund. And I also volunteer a lot of my time in the charity space, including running a philanthropic foundation called Quantage Foundation, amongst others. So on this question about impact investing, the way that I look at it, at least, when we think about investing, we think about large pools of capital that exist all over the world. And this capital is hungry for returns. And of course, traditionally, over hundreds of years, decades, people have talked about returns in the sense of just purely financial returns. And today, that's obviously changing, and a lot of it has come together with the wave of sustainable investing or ESG type investing, and that's really caught a lot of traction, obviously. But that area of sustainable investing is a big area, and impact investing is, you could say, either a subset of that or an extension of it. So it goes beyond the typical considerations for sustainable investing or ESG type investing. Because when you talk about impact investing, then typically you're talking about social impact or positive impact to society and communities and that you're in or that you operate in. So it goes beyond the typical considerations of, is it environmental, is this governance kind of considerations. In my view, it's an evolving sort of process. When we talk about the way that capital is allocated, whether it's for financial return or for other types of return, when you talk about impact, I think it's an evolution. Yep. At the onset, I mean, even if you look at traditional types of investing, it's grown and it's evolved over time. From the typical or traditional markets that people invest in because it's visible, it's easy to access, to less traditional markets, the emerging markets, asset classes that are difficult to find and invest in. The risks become more obvious as people delve into it. I think the same applies to social impact sort of investing. Okay. It's still early days where people are grappling to understand how to do it, how to properly assess what the risks are, and how to determine what's a good return. Oh, okay. So I think as we go on, things will develop. There'll be more and more players in the market, but when we talk about going back to those pools of capital, different investors are looking for quite different things. They're motivated by different things. And as we move along, as ESG and sustainable investing becomes mainstream, so will impact investing. And more investors will start asking about the impact that their investments will generate. And it will become something that hopefully will be a criteria for all responsible investing in the future.
So I'm going to take back on that part about what would be the decent financial return or expected financial returns later on. I think that's the point of contentious, because many a times we heard that fund managers are saying that they demand market returns even if for impact investment into social enterprises because their investors are demanding so. And then on the other side of the spectrum, you have the philanthropy impact investors who might not be too picky about financial returns, but they want to kind of amplify the impact. So how do we meet in the middle to make it a bit more robust? So we're going to touch on that later on. Seta, a bit about yourself and what have you done so far?
Yes, thank you. Thanks for inviting me. Well, you were asking about the daytime job. My daytime job is actually impact investing mostly. So I have been in a VC fund for the last 3 years that does impact investing in South and Southeast Asia. And lately I've set up my own advisory and venture building firm around impact investing. I advise funds, I advise investee companies that would like to, have access to better capital and larger capital within their activities. I also do quite a few work around ecosystem building, both in Southeast Asia and also in the Middle East, setting up impact investing platforms or advising foundations or institutions to move closer to impact investing. So that's basically my activity, which sort of spans a number of countries and regions. And well, one thing that I feel, I think just touching back to what you've said, what I see is that impact is still a very nascent industry. Its definition is still not very precise. How it's positioned across the impact first and finance first spectrum is also not very clear. It's under the banner of sustainable investments, responsible investments, ESG investments. It's still searching for its own niche within that spectrum. And now it's even getting into a larger bundle, which is basically, the whole movement towards private and public companies getting into ESG themes and being part of a larger bucket of asset class, which is basically about social change, climate, and environmental awareness, and what have you. So it's very difficult actually when you go out in front of a investor and say, I would like to get your money. By the way, I'm an impact investing fund, or I'm a company that works within the impact sector. For the investor to really capture and understand exactly how to position you. So for example, when I talk with a lot of investors in Southeast Asia, they tend to have an attitude, which is very common among emerging markets, is that, well, if you're going to do good, let me write you a check, and we'll take care of the philanthropic part, and then we'll talk about business. So those two worlds, the making good and making money, actually still are not regarded as part and parcel of an investment process. I think this is one big hurdle right now that we are facing. It's a challenge for investors to understand what's going on, but it's actually, I think it's a challenge towards the operators within the impact, the actors, players within the impact world to actually define themselves better and also understand exactly where the investor is coming from, that you have to put on the table according to the investor's needs, and the investor's needs might be very different. You know, it could be that they look for market return, it could be that they look for sub-market return, or it may be that they're looking for just to maintain the capital that they put within the company. So according to the types of investors that you have to define them, the sort of the return. But what is very, very important is that you have to really give a sense of what the benefit of what you're doing. And it cannot be only expressed in social and environmental terms. You have to show financial gain in one way or another. And sustainability of its finances, you know, maybe more than financial gain, that this company that they're investing in will generate that type of you know, economic cycle, that it will be independent, it will keep on going, anchored on its feet. I think this is very important. So just to cut it short, I think we're in a phase right now where impact was very defined as a sort of a non-profit activity. This is 7-8 years ago. The pendulum slowly swung towards a sort of a better definition of impact within the financial spectrum. So yes, doing good, but also making financial gain. But still, it's basically an industry that's looking for its own definition and its own positioning as an asset class. And that's the biggest challenge that we have right now.
Okay, so it was quite an interesting point that you bring out about definition. I'm personally not into definition, but we need to have some form of at least a silhouette or markers of what we intend to do. And I will touch back again whether should be top down, as in policymakers or the big boys and the, big investors to define what it is, or is it bottoms up or community up, where technically the social enterprises or the few maverick impact investors would start doing it and say that it's working. So we're going to touch back based on that as we move along. Now, Min, over to you. So being a social enterprise that have managed to attract investments, both as an sector developer, impact investors such as Race, and also institutional investors. So are you a victim or benefactor of impact investments?
Well, I think that's how we look at it, but I must say that I think I'm a benefactor.
Okay.
Mainly, well, we are a social enterprise, and our main business is in the preschool industry. So our main business is to do good, to earn more so that we can do good. We hire and we enroll inclusively. So we have our impact in a certain percentage that will allow us to be sustainable, profitable at some point, and to still serve as many children as we can. So our social mission is equal access to quality education for all children. So on the business side, we serve children who are privileged, children who can afford lessons at our school, schools that can afford our programs. And on the impact side, we also serve children who may not have parents who can afford our fees, but still give them access through what the business can afford in terms of subsidies and through our work with our impact investors.
Okay. So there you go. We have technically one impact investor, one, I should say, a very active social investor in terms of the traditional giving grants, donation, and wanting to look at the prospect of impact investment, and one actually receive impact investment. There are a few questions that's coming in now, but let's put that aside first. And touching back on first your point, Sata, on definition. In your mind, and this is Swami and Min, if you want to interject, please. So, is it going to be top down or sector up to define who we are? When building a social enterprises ecosystem for the last 5 years, we were very mindful not to be top down. Mm-hmm. We kind of have a loose membership association where we bring everybody in, and somehow the social enterprises themselves actually come up with their own identity as a sector standpoint. And it's easier for us to kind of tweak from there on to come as much as possible the definition that actually represent the actual sector. So, but what about impact investments? Is it going to be the same where the big boys or the policymaker will take the lead and say this is how impact investment or impact investors should be, or it should be again committee up? Sata.
Yeah, I mean, I think this is a very good question, and it's also I would call a $1 million question nowadays, because it's when you look at it from the investor's perspective, the investor could be the government, the state, and they might be looking actually to support a nascent social enterprise ecosystem, and they may not be looking for particular returns, but they put the seed money in making this happen. So that's one type of an investor, and that's going to exist. Then there's the private investor, which have a number of different categories, I would say. One is that they might be looking for real market return. What is market return, which is very openable? I mean, it's to be discussed. But if you look at it purely from, investment thesis, then market return is anything that any other alternative investment would give you, as opposed to impact. And in that basis, you have a set of investors who are looking for that type of a return, and that's only possible in certain sectors within the impact investing, such as microfinance, financial inclusion, fintechs, and what have you. And then you will have investors who are looking for a reasonable return, not as low as a state or a government agency, but they will be looking for a reasonable return in the sense that they pose it as a sort of a diversification instrument within the portfolios of their clients, their, the entities that they advise, and they might be looking for, in any case, some type of a churn of money from that activity. So coming back to your question, I think the type of investor will define what the industry is going to look like.
Okay.
I agree with you that bottom up, sure, you're going to have social enterprises which look one way or another. You will have scalable businesses looking for, hefty returns. As founders, might be looking into a different, possible funding alternatives. But essentially, it's at the end of the game, it's the investor's propensity to risk their money, and their purpose is going to define what the industry is going to look like. So we're never going to have a one-size-fits-all impact investing industry, I think, even looking forward. And I think this is only good. And when I talk about definitions, my definition is not a very strict definition. It's an open-ended definition. What is very important that in impact, whatever you do, first of all, you define before you enter an activity intentionally that you're going to do good, because that has to exist. The second part is that beyond doing good, you have to define a return profile, and that's in line with what investor says and what investor desires and what's possible within the realms of that particular sector that you're working in. And then the third leg is that it has to be measured and demonstrated that it's actually doing financial gain. That's simpler relatively because we have all the accounting and MIS systems. It's rather more difficult still to measure precisely the type of social and environmental impact that any industry would have. But there's been quite a lot of impetus towards making sure that we have new methodologies coming in. So if those three aspects are there, return expectations, intentionality, and measurement, that's impact investing. Okay, and then the types of returns and the types of companies that are going to be operating within that sector are going to be quite varied. So we will have a very lively, extremely inclusive, and I think a potential to scale up industry going forward in the next 10 years. And that, I think, should be what should be supported by the market makers or ecosystem builders, so that there is an impact notion that goes across market expectation or types of activities, that the impact notion is there and it's carefully identified and measured.
Okay.
Yeah.
Well, I mean, again, alluding to that point of three things that you say: intent, measure, and returns, right? So let's assume that intent and measurement is there. I mean, everything starts with good intention. And then measurement, there's a few ways of measuring social impact. Although it's, again, not that fully developed, mind you, it's a new sector. But it's key to measure what you have achieved, especially on the social part of things or impact part of things. Now let's touch on financial returns. Now assume that we wake up one day, and I mean I address to both of them, then later to you, this gentleman, and you decide to start an impact fund, and this is your intent, and you will measure the impact. You hire Race to want to measure your impact, and we as your third-party vendors to do so. But then again, how do you approach your investors? Now from you, Suhaimi, and from you, Sata. Suhaimi, you go first. How do you pitch to your investors? What are the expected financial returns, and how do you position it to make it viable for investors? And who will be the top investors that you'll be going for?
Wow. There are already impact funds out there. I think by and large, the way that impact funds are structured today, they are quite thematic, meaning that the manager or whoever it is that's sponsoring that fund is typically a specialist in a particular asset class. So let's take, for example, simply microfinance.
Okay.
So you have guys who are specialists at microfinance, particularly in special jurisdictions or particular jurisdictions, Indonesia, Africa, Southeast Asia, whatever it is. So in any impact fund, typically you're talking about a particular asset class. So when you talk about any particular asset class, and this applies in any sort of traditional investment as well, you can't just say this is the financial return that I think I'm going to be able to produce, because the asset class and the market sort of determines what is the return that can possibly be derived from that investment. So when you look at that asset class and you say, look, I'm going to conduct a microfinance scheme or operation in Indonesia, and I think the market can support a 20% return. And you pitch that to investors worldwide, and many of them will simply assess it on the basis of, is the return attractive? Is there a particular risk that I'm bearing with respect to jurisdiction, political risk, currency risk, as well as operational risk? And that will then sort of balance between the two, because most investors, they will look at obviously what is the risk-free rate. If I invest in US Treasuries, what am I going to get? And anything above that has to be on the basis, if I get additional returns, it's because I'm taking additional risk, right? And if you operate in a jurisdiction like Indonesia and you get 20% returns for microfinance, which may not be possible today, but that was what it started with many years ago, right? Over time, that return is going to be diluted anyway.
Okay, so am I wishful to think that when we approach investors, why can't we start saying that your investment is going to help 200 families, you're going to get your money back plus X percentage, versus trying to be too technical and say what has been done 10 years ago, put it into your asset class, manage your risk, and then come up with a number, whether it's an FX hedging or whether it's an FX cost or vice versa or not. Would there be a position where we can, are there those type of investors in your mind?
I think there are. So again, if we talk about the different pools of capital, you've got, the large bulk of capital in the world today, a lot of it's in the hands of institutional investors, the pension funds, the endowments. Like it or not, they have a responsibility to generate a return.
Yeah.
Right? And they need to generate a return because they have stakeholders that they need to answer to. That money is going to be put to use.
Yeah,
right?
yeah.
So if they don't generate a return, somebody else is going to suffer.
Yeah,
so they need to target a certain level of return. And if you say, I'm doing a lot of good in Indonesia or Africa, but you know what? I'm going to reduce my returns to 3%.
Yeah.
Somebody's going to lose his job. So you can't do that.
This is key. It's not being personal. It's just trying to discuss this. At the end of the day, we talk about, at a global level, so many things about the CEO roundtable saying that stakeholders is more important than shareholders. inequality is getting bad to worse, environmental issues are there as well. Let's all join together and do good. But it does not actually translate to, whenever they make decisions like this, they still want it to be as per normal. Right? So there must be a gap. And maybe that gap is not because of clear intent of not wanting to do things, but maybe of not being informed or not made aware that such things can happen. Things are happening in a smaller scale, but how do we kind of magnify and multiply it? Okay, so Sata, from Suhaimi's point of view, I'll get to her later on, but we spoke a fair bit on this, and you seem to think that your investor, like what Suhaimi is saying, is they're not gonna willing to basically haggle or discount on the returns. They want it to be as market as possible. Is that what you feel as well?
Well, the investors could be different types of investors. Not all investors look exactly for the same type of return. There are investors who are more, I would say, commercially minded. They would be looking for investments that are, so-called market return level. And there, if you're launching a fund manager working on the traditional assets or impact investing assets, has to be very clear about exactly what type of target he or she should have in terms of the investor profile. If the investor is asking for market return, which means that you're going to build a fund that will generate that type of a market return. And probably you're going to put a lot of finance companies in your portfolio, because those are the only ones who can get that type of return. You can sprinkle a bit of other sectors, but the likelihood that they're going to have such high returns are very, especially if they're predominantly working in the impact space, is going to be rather limited. But what you can do is that if you can actually talk about funds that can invest in different types of instruments, so not only equity instruments, but also debt instruments or other alternative investments, which do have a measurable social and environmental return, you might actually build a portfolio that might appeal to both your impact constituents and to investors who are looking for a hefty return. So a fund manager, essentially, when a fund is being launched, the investment thesis is important. And within the investment thesis, there's your purpose. Well, why are you doing what you're doing? For example, when you look at an institution like yours, Raise, Raise has a purpose. Its investment thesis is that it has to support the social enterprises in Singapore, and those social enterprises need funding, they need advice, they need hand-holding, they need guidance. This is your purpose. And it might be the purpose that guides the types of investments that you do, and you may not be looking for these, typical market returns, because your investment thesis is not geared towards that. And there's nothing wrong about that. What I'm saying is that we have to be very mindful of what impact investing can achieve and how it manifests in different types of scenarios and how it actually sort of changes shape according to the investor needs. Yeah. And this is what's going to make the sector much more mature than it is right now. Because right now, if you're looking at it purely from a developmental angle and a non-profit angle, which was the genesis of this industry 7-8 years ago, it was absolutely impact first, and let's forget about returns. Returns if they might come. And from there, we've actually come to a much more sophisticated industry whereby investor defines and emphasizes what type of return it wants, and then the fund manager makes up a portfolio that actually reflects that. So there's that type of a dialectic between the two parts. And I think that is going to only make the industry grow better because there's a dialogue of parts. So if you want to actually attract more money, you have to be very mindful of your client, in this case, your investors' predisposition. You can educate the investor, fine, but you have to be very mindful of what the investor wants. So that's but asking pretty much on your end, if this, when you went to raise funding for your company.
Yeah. I think that was my question to you. But Swami, you got something to say?
Yeah, I just want to add. I mean, Alfie was asking, if I were to set up a fund, who would I go to? And I think part of the problem, or not the problem, but what needs to be solved here is the difference between a principal investor and an investor investing through an agent. And this is what I talk about. An agency type of relationship where you go to an institutional investor who has stakeholders to report to versus a principal investor, meaning someone who is making decisions by himself. The difference is stark in the case of impact investing because when you talk to a principal, you can tug at the heartstrings. You can say, this is the intangible part of the investment that I'm pitching to you, the impact that I'm going to deliver, which you cannot talk about in dollars and cents. Well, you may be able to translate that to dollars and cents, later on, but I think there's a big difference in terms of how you can appeal to those two types of investors. Maybe you would have experienced that as well in your journey.
I think that's a good question. That's a good point. So Min, over to you now. You have done it. You have walked the walk. How do you, don't say about race, but about the institutional investors, how do you manage the expectations?
I think, I completely agree about principal investors and that. I think the expected, or the expectations and the intentions have to be right at the beginning. And in terms of returns, I think they were very clear in terms of the impact, social impact returns, as well as financial returns. And so were we at point of presentation. So I guess at a point in time when we both presented, even to raise an institutional investor, we were very much aligned in that sense. Yeah, and I guess when we had the certain level of alignment in terms of financial returns as well as impact returns, I think that was where we worked out. Because through situations and through business changes, like, COVID just happened, we are an educational institution, things like that, the nature of the institutional investor and raise, they were very nurturing, very understanding to the situation, to how impact might have changed the business, and that actually helped us become more agile and move towards education technology a lot faster. So I think I completely agree with you in terms of the principal investor and in terms of alignment in that sense of returns, not just financial returns but also impact returns.
So it's a healthy or unhealthy tension, the fact that the hypothesis or assumption to that point where if you are making more money, it's lesser impact. You're making more impact, it's lesser money or lesser returns. Is that healthy to you, or is something that you can rebut back and say that that's not the case for you all?
I think that's very healthy. That's as good as healthy competition, Okay. We strive to make more money because we want to do more good. So that intention is very clear. And the fact that we are working towards social impact and hoping to serve everyone, we continuously want to improve research and further develop our products. So we are a lot more competitive in that sense. We always strive to be better than before. And I think that motivation is not just a financial motivation, but from the team as well. It's very purpose-driven sort of intention. Yeah.
Okay, so, you can get all the views now. I think the point of definition, the point of, the difference between an agency and principal investors, and from a social enterprise standpoint that receive this money from investors, how do you manage this and kind of look this in totality as a healthy issue that you face in trying to getting yourself better and better to do more. But the market can be unforgiving sometimes. Right? The intent is always there. And this is maybe a fallback on what Grace is trying to do. Maybe from a whole ecosystem perspective, we saw that social enterprises that are more investable are mostly those that are scalable. That's true to that matter. But in being scalable, the persona of a social enterprise is more of an enterprise than that of social. Now, how do we, in a way, is it good to define even entity like mean called social enterprise, or can we just say, so is that just a definition thing, or is this something that is a stigma where, to some investors, social enterprise is not exciting because it's more social than enterprise? So in your mind, do we need to, we look at it at a different angle, because at the end of the day, mean is as enterprise as it can. So, but somehow the English language, you cannot present it, school of concept is an enterprise social. I mean, I'm not an English, professor or in that sort, but then is it social business? Is it social, or does it even matter?
Yeah, I think in a sense, over time, we might even, I always do this as a provocation, try to write an investment thesis for a fund that actually operates in impact without mentioning impact.
Okay.
So that the impact is embedded.
It's given.
It's given. It's there. Because you're serving a certain group of customers, populations that might need that type of service. Without you, maybe they may not have access to that service. You might be operating in a geography which needs you. You might be doing a business, even in the tech area, that people have not seen such a, that it might change the lives of people. That it is embedded, and it's not something that is put on as a sort of a tag on them, because the moment you actually go out into some of the markets with social impact and all of the terms and the connotations, even if it's still a buzzword right now, nowadays, everybody seems to be talking about, how the world should be much more towards stakeholder enterprises. There's a sense of putting anything that's social and impact into a ghetto. Almost you're in a ghetto and you cannot get out of that ghetto, and you're sort of tagged for life. So I think that the challenge that I say is that if you think that you're actually doing social good, try to demonstrate it rather than present you as a social enterprise, and say that, yes, I'm in that business and I'm yielding these types of results, and this is how you should look at it. I mean, it's easier said than done, but you have to try this, because it does give you much more sense of what can work and what cannot work. Dilution is a problem. When you mention any of these terms, usually the type of reaction that you would get from the investors is a haircut on the amount of money that they would give you, because automatically you're in the philanthropic or the venture philanthropic bundle, not in the typical investment bundle. Now, the big names are moving in, like the KKRs and the Apollos and Bain Capitals. And I am welcoming, for example, mainstream, but at the same time, I'm also very skeptical of how much of that is genuine, because you cannot, on one side, do tons of business which are actually not yielding good, or actually in some ways yielding a lot of harm. And then on one hand, in another business line, you give the impression that you're going to change the world. So I would, when you, for example, you go to some of these association meetings, like the private equity association meeting or the venture capital association meeting, and then there's a bunch of impact investors, small firms, small funds, and then there are the big guys who are getting larger and larger and more raucous and more, opinionated about impact and ESG and sustainability, but it's completely cosmetic 90% of the times. They're like literally talking over you, and and the tendency is that they'd like to crowd you out.
Yeah.
So, I was a banker for 25 years, so I cannot pretend that I come from a typical, NGO or a nonprofit world. But just because I was a banker, I know how they reason. And we have to be very mindful of telling them sometimes, I don't think exactly you're doing what you're preaching. And we have to have, I think, a social responsibility to actually demonstrate that what they're doing is actually not essentially yielding good. And I'm talking about the ecosystem players. You know, a lot of people are doing this. And this is going to happen. So the tension is good, I think. Tension is only going to make this work better, I think. Because then we'll converge in that middle ground. And I'm relatively optimistic about it in the next 5 to 10 years, where impact will be, measurement will be almost, and the accountability will be pretty much like financial accounting.
Yeah.
You're going to have Deloitte's and the KPMG's and the EY's, while they're doing their financial accounting and auditing, they're going to do social and environmental auditing, and it's going to be part and parcel. So we're going to see companies, what they're doing, how much good and how much bad they're doing. So that's where things are going to go, I think. But in the meantime, there's going to be a lot of tension, which is only good.
So, Min, when you present to the institutional investor, which variable do you put it first? Business first or impact? When you pitch to them, what's the angle first?
Well, I think in that sense, our business and our impact are both very aligned. So I'm glad that I don't fall in the category of, doing harm one side and putting aside money to do good on the other side.
I wasn't referring to you.
Yeah, no, I'm just kidding. So yeah,
There's a hedge fund manager beside you.
So yeah, I think in that sense we explained the business, and we also shared about impact along the way. And I'm glad that the institutional investor, they actually saw potential. Even in the area of impact that we were doing and we are still doing. So along the way, they have also improved and helped us, in a way, nurture us to become even better. Likewise, like what Race has been doing all this while. So I think that has been very, very useful, because when we shared about the impact and they saw opportunities in the impact area, it has also benefited the business in that sense. And the business has had the opportunity to move faster than expected. So I think, in terms of the sharing, don't remember sharing which one first, but I think it was more along the way we were able to share and include impact in the business model.
Okay.
I'll just make a quick point, Alfie. My quick opinion is, I see it as a spectrum, right? And this spectrum is evolving. On the one hand, in the past, you have corporations which used to think that the only thing that they responsible for is to increase shareholder value. And then on the other end of the spectrum, you have charities, which were the traditional vehicles from which you do good. You don't expect a financial return there. People donate to it and don't expect anything back, right? They do social good, that's it. I think there's a convergence, right? In the future, every single corporation out there is going to have that social good angle to it. They're going to be measured, they're going to be tested based on that. And if you don't do social good, then you're not going to be funded. That's eventually going to be the state. Today
or your clients are not going to buy your products and services.
You're going to be boycotted, right? And because of social media, it's going to gain traction. Those kinds of corporations are just going to die by themselves. So eventually, all corporations will be social enterprises.
So every enterprise will be a social enterprise?
I think so. And I think in addition to that, from the right side, when you talk about charities as well, I think there's going to be a move towards charities themselves being sustainable. Charities need to figure out how they can sustain themselves. They can't forever rely on donation dollars. They've got to find out what is the business model where I can generate some profits, stand on my own 2 feet, and move towards a profitable model, which is more like a social enterprise. So I think there is that convergence that's taking place.
It's a matter of time, and it's a matter of setting the ecosystem right so that it can be more conducive. Right. So let's jump into the Q&A. There's a few that I see that is coming in. Some has made some direct attention to all three of you. So let's start with Min. Basically, our friends at the Zoom platform wanted to know what were the experiences of raising capital, the good and the bad, and what the hurdles and the plus points, and just share a bit how difficult or how easy it is.
Well, I think if you've got a nurturing investor like Race, it will have been a really, really pleasant experience. Because as a social enterprise, we are very impact focused. Well, I'm in the preschool space, so my experience is being a teacher, don't know very much about big figures, but Raise has been most nurturing, and they have guided us very, very much. So raising capital was really very much about explaining the business model, helping our institutional investors or our potential investors look at scalability of how or where we're moving, the reach that we're looking to expand, areas we're looking to expand into. And then, and then helping them see, and these are, I mean, our investors are smart people. They straight away saw the potential in it. And so I must say the experience has been very, very pleasant.
Okay. So to both of you, Sata and Sohaimi, again, assuming that you are running an impact fund, the question here is, what are the impact areas that you'll be looking at that can maximize the financial returns in your mind? So is it environmental, is it BOP, is it vulnerable communities, but what would be an impact area that in your mind have maximum financial returns?
Let me just start and then I'll leave you the word. For example, right now we're sort of toying around with an idea to launch a fund that will be essentially an impact fund, but a fund that invests in companies that have scalable business models if they're operating within the impact, social or environmental impact arena. Which means, what is a scalable? Scalable is that it can be actually quickly at national, regional, even global scale, and that the businesses themselves are replicable, and that they leverage either technologies or innovations that can reach to a larger group of people. So if you take this as a thesis, then your impact multiplier is larger. And yes, there are not many companies that aim to do that, but there are enough companies that you can actually invest in. There are enough entrepreneurs who are not necessarily looking at community building or other forms of very valuable impact or environmental support to certain regions. These are all very good. They might not be scalable because for the types of investments and for the types of enterprises, they actually operate on a sort of a community or on a sort of a, let's say, a very limited geographical level. But there are many out there who would like to do stuff that can resonate at a greater speed in a larger context. So those are types of investments that might bring a huge amount of financial gain.
So if in one point when the sector matures, can we see, say for example, impact funds that is dealing in environmental, the market benchmark, no matter whether it's global or regional, it will be X percentage returns, impact fund dabbling in BOP or education and some sort. Will you foresee that there's a benchmark of some form of expected returns against the impact areas that they're trying to achieve?
I mean, I'm not exactly sure if I would use the word benchmark, but if I would use comparative analysis, yes, you will see that. I mean, first of all, there are various degrees. As I said, so far, up until right now, fintech, financial inclusion, whether it's microfinance or derivatives of microfinance, or even funding to microfinance entities, which debt funding usually. These are industries that within the spectrum of impact had way above market returns. I mean, the market returns could be rather comparable to other types of commercial enterprises. Mm-hmm. If you look at other bundles of impact investings, the second bundle has been around finance embedded distribution activities, for example, affordable housing or financing for consumer needs or financing for property development needs. These are also sectors that actually yielded quite a bit of both social impact, because you're catering to, especially in India and elsewhere, catering to a larger population that had an excellent service from these companies, but at the same time, they made a lot of money, these companies. And then, I don't want to get into a lengthy argument about it, and then you would have many other companies that are sort of in the middle, that are well run in sectors that will yield good returns, but not necessarily stellar returns.
Yeah.
And then you're going to have a lot of sectors and a lot of companies that are, barely making it, because the type of business that they're in essentially are complicated business, catering to bottom of the pyramid populations, or catering to people who don't have a spending power. These are necessarily companies that need to be supported through a social enterprise network or funds by states or foundations that do the first loss. So a blended financing instrument.
Yeah.
So I mean, I think these are the types of things that we see. But there's another group which is basically scalable, technology-based impact initiatives that can be scaled up at a larger phase.
So I mean, you agree to that point where let's not focus on impact against financial returns, but just being very strategic and see where the gaps are.
Yeah, I think so. To some extent, you're right. I mean, your original question was, what area should an impact fund sort of focus on now to get highest return, right?
Yeah, that was
and
a
there's a lot
question
of
from
so many different factors that go into that. I mean, the quick answer to that, just as an example, you look at renewable energy, right?
Yeah.
And that's impact investing, right? You're trying to reduce carbon footprint, make this place, the earth last longer for us. That's done fantastically well in the last couple of months, right? Beating any other financial sort of markets out there, because we're talking about 30-40% returns. And that's a confluence of different factors. The fact that everybody's more alive to environmental concerns, the fact that potentially this presidential election going to lead to some change with respect to environmental policy.
Yeah.
So I think part of when you talk about returns when it comes to social impact sort of investing, it also depends on how ready the market is for it. And this links to the question of scalability, because if the market's not ready for it, if people are not willing to adopt whatever change you're trying to implement, it's not going to grow. Right? So now's the time for environmental solutions to come in, renewable energy to come in. Bottom of the pyramid, inclusivity in terms of fintech going in to service the population and give access to people. I think that's going to come as well. And when the wave comes, that's when the financial returns will come in. So I think anyone who's setting up a fund to invest based on impact and wants to have an eye on financial return needs to be able to time it correctly as well. Because if you're fighting against the tide, you're not going to get the return.
Okay. And I think that's a fair point. It's all about timing. It's all about opportunities as well. But in any market, there's demand and supply. And this is maybe a question for me, to a certain extent, a live example that Min is having. Do you think that there are enough investable businesses or investable social enterprise in the region? Or how do we kind of make it a bit more robust as far as the pipeline is concerned? Or do you think no point setting up a fund because there's not many to invest in this part of the world? I mean, this is an example that it does, but early stage, not to an extent of Series A or beyond, but we have to start somewhere. So what are your thoughts on that?
It's very contextual, isn't it? I mean, because you're a Singaporean company, and Singapore has a great ecosystem of sustaining social enterprises. She feels safe. She starts investing even her money, her time, effort. She goes out to investors, and the investors, our private investors, say, oh, somebody made you grow and made you flourish. Now it's my time, my turn to step
scale,
in. So just looking at it from a story narrative perspective, this is exactly what should happen in industries that may not, in a very short time, scale up or yield those hefty returns.
Yeah.
You have to have a very good ecosystem that actually supports them, so that that people who are talented like Min can actually, stay on their ground and make sure that they actually achieve results. Well, if you go to other countries, that's not there, unfortunately. I mean, Singapore's might and the great, I think, force about Singapore is that it foresees problems and it acts upon them, whereas many other countries, it does not have that type of a network. Very few places have that type of a robust network. There are parts of India where actually, impact investing is a huge and extremely lively sector. But if you go to like Indonesia, it's completely dependent on money coming from DFIs and foreign investors. While there's a lot of money elsewhere because people are giving gifts to certain institutions and certain entities. And how's that money going to be deployed into impact investing is going to be the challenge. I mean, I can give you tons of examples. We've just set up a platform in Turkey, for example, in impact investing, same issue. The people don't want to invest because there's not a state mechanism that does the first loss, which is the sort of let's get you off the ground type of funding. And that's what we're aiming at, copying pretty much Singapore's model, because that's the only way you can actually have a robust social enterprise system, whatever you want to call it. I don't know if that has been your experience also.
Yeah, I think you clearly articulated the whole journey.
So ecosystem builder, or the first laws of blended finance.
Very important. Extremely important.
Okay. So we are coming to an end shortly, but before I let all of you go, last words of wisdom and thoughts on how to move the needle and bring it to the next level. Maybe in this time, let the ladies go first, and from a social enterprise point of view or social entrepreneur point of view, you have walked the walk. I'm sure you have many challenges. I think you are being very nice and optimistic this afternoon, which you usually are not. You're a very feisty type of personality. But nevertheless, I guess in your mind, if you were to advise a budding social entrepreneur or social enterprise to be scalable, to be investable, what would be the kind of advices that you give them?
Well, I think I'll leave with a statement. People will pay you to solve their problems. So as long as the social enterprise finds a formula to get people to pay them to solve a social problem or a problem that they face, then I think they will be investable because they will be able to find profits there.
Okay. So it is not about what you know, but it's about what you see as a gap in the market. And that's a very entrepreneurial mindset, right? I mean, if given a chance, I want to be a football player, but if I'm not a good football player, what else can I be, right? So very practical. Okay. Sata?
Well, I mean, it's sort of, just extrapolating on what you said, there's nothing romantic about, running a business. Running a business is running a business. You have to be very extremely mindful of that business generates the income that it needs and is mindful of its cost, and that there's funding for its business, whether it's long-term, short-term, whether it's cash flow or whether it's investment. It's purely, at the end of the game, once you've defined your purpose and where you want to go, that you have to have management techniques. So when young people come to me and say, I want to, right after university, I want to launch, I want to go into the sector and work, I tell them, go have an experience elsewhere and then go back.
Start something.
Or start to move into what you call as sort of a more romantic social enterprise entity, because it's all about really juggling many balls in the air. And at the end of the day, you have to be very, very good in managing a company like that.
So from an impact investment ecosystem, Sata, what do you think would be the best thing to do to move the needle up or to make a decent progression up?
I think impact investing has to show the benefits that it does. It has to clearly identify, demonstrate what type of social impact that it has generated, but it has to have an excellent track record in terms of financial gain. It's a very nascent, industry. So I think it goes back to 5-6 years ago. So we don't have a big track record yet in terms of exits and also other performances. But in the next 3 years, once we move the needle towards 2023, the first generation of investments are going to be divested. You have to show to the market that you are actually doing exactly what you're preaching, which is, making sure that there are social returns alongside financial returns. So if you're not going to do that, you're not going to be absolutely credible. So I think we need more rigor.
Fair point. Yeah.
Yeah.
Swami?
I'll mention a couple of points. One, the first point is I think the greatest potential with social enterprise is the potential for innovation, right? There is an urgency there to find solutions, to find new innovations to solve social problems. So I think that's an area that needs to be nurtured. One of the biggest gaps, I think, is the measurement of the social impact. So I think when we're talking about closing the gap and making social impact investing more palatable or more attractive to institutional investors or traditional investors, we need to be able to, in a sense, monetize the impact, right? How much in dollar terms, what does this impact mean in dollar terms? So I think that will help a lot. And I think the other thing that I hope to see, at least in Singapore, is from the other side of the spectrum, the area where foundations, philanthropic foundations are operating.
Okay.
I think in that space, there's huge potential for all those charity dollars to actually be deployed in social enterprises, provided that, I think, in a sense, definitions or regulations are cleared up, which will allow foundations to invest. Because at this point in time, when we talk about charities and IPCs, it's largely about just grant making, donations. Can we invest? You know, we're not taking the money, putting it into a risky investment, and then potentially losing it. That's fine. I mean, we're trying to experiment for innovation's sake. So I think there needs to be some clarity there in order to enable foundations and charities to take a bit more risk, but at the same time keep those resources within the social sort of landscape.
Okay. Fair point. And we can follow that discussion on another platform, which allude to, as part of our ecosystem builder, how do we bring foundations into the social enterprise ecosystem? I think with that, we will have to close this event. I must say it's 1 hour has just flew past. I don't think so you're going to leave as strangers. We're going to get connected. Many thanks for your support. Many thanks for being here. This has been a fantastic chat. So thank you once again.
Thank you.
Thank you.
Thank you.
Thank you, panelists, Suhaimi, Sheta, and Mint. You all have been a real asset to us. And to the audience over Zoom and on the conversation platform, we hope you had a fun time at this conversation today.